Well, good morning or good afternoon, and maybe good morning for anyone who's west of us here on the East Coast. And thank you for joining us. We got a lot of good information today. We want to go through first quarter market and economic update, talk about what we're seeing in the markets, seeing and taking a look at some of the economic data and information that's driving some of those decisions, talking about some market themes we're seeing and what that may mean moving forward. So with me today, I'm Ryan Boucher and excited to be here with all of you. I have Paolo LaPietra from our team who is also going to be presenting. So why don't we jump right into it? So today we're gonna, I talked a little bit about it a few moments ago, but we're gonna focus on right now, market and economic, both ends, we're seeing a lot of momentum. We had a strong CPI report come out this morning, even though markets are down, for the time being for today. We've had a great start to the year, and we're seeing a lot of, again, not only market momentum, but economic momentum as well. So we'll go over a first quarter recap. We'll talk a little bit about the economic overview, talk about the Fed. We'll talk a little bit about fixed income interest rate environment. And, we'll wrap up by talking about our market outlook and expectations moving forward. So we made this change on the fly this morning. I thought with today's CPI report coming in a little bit hot, it was appropriate seeing inflation still kind of hovering out there. I know expectations, I think, leading into 2024 that inflation was under control. We can talk a little bit about what expectations were for the Fed and interest rate cuts. But, as they say here, higher for longer. And again, with inflation coming in at about 3.5%, well above the Fed's intended 2% target that they're trying to get us down to. So talk about what's really driving that and how that's impacting, both the markets and the overall economy. When we take just a quick year-to-date market recap, just looking at the major indices, S&P 500 is leading the way. The Nasdaq's not far behind, but it is a little interesting. Typically, you do see in bull markets, especially, you tend to see Nasdaq kind of leading the charge, and it's keeping pace with the S&P. It's not lagging by all that much, but it is interesting to see it lagging by a little bit. In a bull market that we're seeing so far, and in the growth we've seen in the first quarter. Below that we have the Dow Jones in blue up about 3.7%. The Russell 2000 small caps, we included it here today, up around 3%. We'll talk a little bit about why we're probably seeing some lagging there in performance with small cap stocks. And fixed income, we're seeing interest rates on the rise since the start of the year. Fixed income is down a little bit, but even though that can probably feel a little bit frustrating with the defensive piece of your portfolio, the good news is we're locking in these high rates. Even though we're in a higher interest rate environment, there may be some market value decrease there, but when you're yielding 4.5, 5+% right now, much different environment today than we've seen in quite some time. So that can be a little frustrating, but the yields that we're getting are really strong on a relative basis, especially over the last 20 years. When it comes to our portfolios right now, not a lot has changed. You may see some changes in the coming weeks that we'll talk about, but as of now, our overweights tend to be kind of similar to what they've been in the past. We're still U.S. equity overweight. Technology is the biggest piece of that portfolio in the equity side. We've talked about quality, the reasons for that. We've talked about growth a little bit. Growth meaning both, maybe growing dividends, growing earnings. We like companies that are making profits in this environment. And we've continued to hold short-term bonds, and that's been tactical. As we've seen higher rates, our thesis has been probably a higher rate for longer. And again, with some of these strong reports that we'll talk about later in the presentation, those short-term holdings are helping us until we can put them into maybe some longer dated bonds when we feel the time is right. Continue underweight international equities. High yield debt really there's not the risk premium that you'd like there. So we're kind of more a little bit defensive on the fixed income side. Small caps, we lowered that exposure last year, and you saw sort of the year to date returns in the Russell 2000. We'll talk about why that is. The big reason being is that small cap stocks don't hold up as well in a higher interest rate environment. In real estate, same struggles that we've seen over the last couple of years, and continue to stay away from that asset class. So with that, I'm going to turn it over to Paulo, talking a little bit about the economic overview. Take it away, Paulo.
Thanks, Ryan. So let's start off the economic overview by looking at the US's GDP growth. Chart on the left shows quarter over quarter and year over year GDP growth in the US over the last 20 years. And 2023 was a strong year for economic growth, with Q4 of last year marking 6 consecutive quarters of growth above 2%. Now, if we take a look at the right side of the graph, we'll see the breakdown of the US GDP. And the consumer is still the main driver for the US growth, making up over 67% of GDP. So while it may be difficult to match last year's GDP growth, this year still looks like another year of expansion, and the health of the US consumer will continue to be a key focus. So on the next slide, we'll take a look at some consumer finances. So one of the biggest concerns when the Fed started raising rates to help cool off inflation was how much of an impact this would have on the US consumer. Looking back to 2022, during that market and bond sell-off, which hopefully is out of everyone's memory now, there was doom and gloom around the health of the consumer. And it makes sense. The consumer was facing much higher borrowing costs than they were used to in the last 20 years, give or take, and they were losing purchasing power due to inflation. Where we could see the material effects of this is by looking on the graph on the left. This graph here shows the personal savings rate of the average US consumer. The average savings rate over the last 60 years was 8.5% of disposable income, and this gets close to being doubled during the beginning of the pandemic. We could see this number drop off pretty significantly in 2022 till now, as the consumers battled higher prices across the board. And while this could be a cause for concern, I think one of the most overlooked aspects of how much money consumers were able to save during the pandemic, we could really see this on the chart to the right. This is looking at the household excess savings. And again, we could see the personal savings rate drop below the pre-pandemic level trend in 2022, but there's almost $1 trillion of remaining savings from the pandemic, which we could see in that shaded light blue. This, in my eyes, has been a main driver for resilient consumer spending over the last few years, but it can only buy so much time for the consumer. So in order to continue consumer spending, we need a strong US labor market to support it. And on the next slide, we'll take a look at the overall labor market. So now, while the US labor market hasn't normalized, the US labor market has normalized since the post-pandemic boom, the US economy has added an impressive 250,000 jobs per month in 2023, and we sustained this pace so far this year, which we could see represented on the chart to the left. The blue bars are showing the monthly job gains, while the gray bar shows the 3-month moving average. What's even more impressive here is the labor market has been growing at this pace while keeping the unemployment rate at or below 4% since December of 2022, which is the longest streak in US history since the late 1960s. On the bar to the right, we're looking at the labor force participation broken up into 2 groups. The blue line is ages 18 to 64, also known as the prime age group, and the gray line is the overall labor force. We could see the prime age group has now surpassed where we were pre-pandemic. This is a very, very strong US labor market, which is a pivotal piece to keep the US economy growing. From the last slide that showed the excess consumer savings, that was Sam Kawia. Go back. Yep, sorry. So in that last slide, when we were seeing that excess consumer savings, while it showed the consumer still having almost $1 trillion in excess savings, it's been coming down steadily from the highs from beginning of the pandemic. So a strong US labor market is needed to keep a sustainable pace for spending. In the next slide, we'll take a look at where we stand with inflation and review inflation numbers we received this morning. So positive news on the inflation front is we come down sharply from the peaks we saw in summer 2022. The challenging aspect is we haven't seen a meaningful decline since October of last year. This morning confirmed that struggle with inflation, coming in a little bit hotter than expected at 3.5% year over year, and core coming in at 3.8% year over year. Taking a look on the graph on the left, this is looking at headline inflation, which looks at all areas of spending. What's been key in bringing down inflation over the last year or so has been the steady decline in energy costs, and we could see that represented in the green bars in the contraction territory of the graph. This trend has been reversed so far this year with energy prices on the rise. Shelter costs or housing costs have been another area with a very similar story. We've seen shelter costs come down through the end of last year, which was a very much welcome sign in the fight against inflation. However, that trend has also been reversing. To put this into perspective with today's CPI report, shelter and gas combined contributed to over half of the overall monthly increase. This is going to be a challenge for the Fed on where they take interest rates going forward, and something I'll review in the next part of the presentation. So to recap, coming off of 6 consecutive quarters of growth, 2024 looks set to be another year of expansion. Consumer spending continues to be a strength, which is important since it makes up over 65% of the US GDP growth. But we have seen some stress on the consumer, with savings coming down from the pandemic highs. All signs point to a very strong labor market, which is important to sustain a strong US consumer. And finally, inflation remaining sticky above 3%. We've come a long way since the summer of 2022, but today's CPI report coming in hotter than expected at 3.5% is another reminder that there's still some ways to go. So on the next part of the presentation, we'll talk about the Fed and our fixed income outlook. Here we're taking a look at what the Fed is forecasting for interest rate movements going forward versus what the market expectations are. Last year, the Fed sparked some investor enthusiasm when they signaled that they would be cutting rates anywhere from 2 to 4 times this year. Market expectations took this and ran with it. Some market expectations on the high end were pricing in up to 8 cuts at some point this year. Now, recent economic data, specifically inflation data like we got this morning, has really reeled in these expectations. If we take a look at this graph here, we could see where the Fed currently has interest rates, which is shown on the solid gray line at 5.38%, right in the middle of that Fed's target range of 5.25% and 5.5%. Where we go from here is broken up between what the Fed's estimates are, which is highlighted in blue, and what the market expects, which is highlighted in green. Now, during the last Fed meeting, Jay Powell came out and said that they're still forecasting 3 interest rate cuts this year. With inflation data like we saw this morning, it's becoming increasingly unlikely that we'll see all 3 of those cuts. Will rate cuts still happen at some point this year? They could. But if we continue to see hot inflation data, it would be likely that 3 cuts could potentially be out of reach. In the next slide, we'll take a look at what this means from a risk-reward scenario for bonds. So positive news of high interest rates is bond yields are attractive, and their long-term outlook is even more attractive. The first graph I want us to take a look at is the graph to the left that lists out a number of different bond categories. And if we take a look all the way to the right of that same graph, you'll see bond correlations to the S&P 500. Now, the way that these correlation metrics work is if an investment has a 1 correlation to the S&P 500, then it follows the S&P's performance very closely. If it has a negative correlation to the S&P 500, it means your investment won't move in relation to the S&P 500. This is an important aspect when building a diversified investment portfolio. It kind of goes back to that old adage, don't put all your eggs in one basket. So over the last year, we've been very proactive in adding treasuries into our clients' portfolio as we've seen higher yields. But the other important piece, and as you could see from the graph, is treasuries have a negative correlation to the S&P 500. So it's been a great way of adding some solid yield to the portfolio while also continuing to strengthen the portfolio's overall diversification. Now on the chart to the right, we're looking at what the impact would be to different areas of the bond market if interest rates rise 1% or fall 1%. I won't go through each bond class, but what you'll clearly see here is there's certainly more upside for bonds across the spectrum than there is downside. It's important to see these risk versus reward outlooks since there is the possibility that strong economic data could push yields higher. But regardless which way rates move in the short term, the risk profile for bonds are very attractive. Now, on the next slide, we'll take a look at some fixed income valuations. So here we're taking a look at fixed income valuations, and the specific metric is called yield to worst, and this is across all fixed income sectors. And yield to worst is just how it sounds. It's the return an investor would receive if the worst case scenario were to occur. This chart looks at the 10-year range for each sector, with the pink bar showing the 10-year median return and the blue diamond showing the current return. In the focusing on US bonds, which is the left side of this graph, we not only see the current return higher than all the 10-year medians, but also the current return being on the higher end of that 10-year average. So some really attractive value in the bond market right now. One area I also want to highlight is municipal bonds, which we'll take a look at the next slide. So municipal bonds are offering some very attractive yield for high income investors. This first chart on the left is showing the tax equivalent yield for AAA and BBB municipal bonds versus the yield for US Treasuries. And as a reminder, the tax equivalent yield means how much an investor would need to receive from a taxable bond to provide the same after-tax return for munis. So in this example, the tax equivalent yield is assuming the investor is the highest federal tax bracket. And what we could see is that the tax equivalent yield on muni bonds are providing some very attractive yield, especially on the longer end of the curve. What also makes munis attractive from an investment standpoint is their bond solvency rate, which we could see on the chart on the right. This chart looks at the default rate compared to muni bonds, which is in blue, and corporate bonds, which is in gray. AAA has a 0% default rate, while BBB only has about a 1% default rate. So in the muni space specifically, the risk profile on going down on the credit spectrum to pick up some additional yield provides a lot less risk than doing so with corporates. So to recap here, the Fed's target of 3 rate cuts at some point this year is being put under pressure with sticky inflation. Again, today's inflation report is going to make it challenging for the Fed to cut rates any point soon. Bonds are providing some great diversification and also have a positive outlook. We saw this with treasuries having a negative correlation to the S&P 500. And also there being much more upside for bonds if rates drop 1% rather than the downside if rates rise 1%. And finally, muni bonds are providing some strong tax equivalent yield for high income investors. We saw how muni bonds had a lower default rate compared to corporate bonds, making it more comfortable going down the credit spectrum to pick up some additional yield. And for the next part of the presentation, I'll pass it off to Ryan to share some market outlook and some closing thoughts.
All right, great. Thank you, Paulo. So yeah, let's jump into it. We'll talk a little bit about what we're seeing and what the outlook is from here. Things we're focused on. Obviously, the Fed has been a huge topic of conversation over the last couple of years, really. It hasn't really changed, but I do think the perspective of it has changed a little bit this year. And I do think, as we move forward, the impact is certainly changing. But, the one big sort of change we've seen or maybe an area that the overall market in commentators have gotten wrong is this idea of how many cuts we're going to have. And so, this cartoon rate cut, note, just another mirage. And again, after last week's labor report, today's CPI report, expectations for Fed cuts has come down pretty dramatically. So let's take a look at that. Heading into this year, the expectation for the year was, somewhere over 5, probably closer to 6 interest rate cuts for 2024. The market was really pricing that in to start right around March. If you attended or have listened to our State of the Economy, if you haven't, I encourage you to go to our website to take a look. We presented that, the last week of January or so. But we've continued to say, we think we're going to be in this higher interest rate for longer environment. We really weren't buying into the fact that, we'd have as many cuts as they forecasted. And we certainly didn't think that we would start interest rate cuts in the first half of the year. And after, this chart's actually a couple days old. After this morning's CPI report, expectations are down under 2. Like I said, forecast was closer to 5 or 6 to start the year. We're down to closer or under 2, to be honest. And the first expected cut at this point is not until September. Who knows what will happen from here? It may only take, one outlier report, whether on the jobs or inflationary, but, we're starting to see kind of more of an upward trend in both of those areas. And that's going to be a major driver for what's next for the Fed. And what we had said from a risk management, right? We always talk about risk management, whether through financial planning, the investment management that we're doing, but from a Federal Reserve perspective and a Jay Powell perspective, managing their risk, their biggest probably risk at this point, based on data and everything else that they're taking into account, is that they lower rates too quickly and they see inflation spike. And, they haven't dropped rates from their perspective yet, but we're starting to see a little bit of a creep up in inflation. So let's go to the next slide. This is data, really Paulo has kind of already touched upon, but you do what I think is most interesting when you see it. So on the left is jobs growth, on the right is just inflation. And you're really seeing sort of that trend in both almost mirror each other, right? You started seeing job growth kind of come down. It was slowing over the last year or two, especially into the end of 2023. And, inflation was coming down at a pretty good rate along with it. But since December, we've seen some strong jobs reports, and we've seen a, slight increase in that inflationary report, whether it's, 1 month changes or even that 3-month rolling changes. And I do think that's important. One of the, biggest factors, I think, to this inflation conversation is the labor market. And, as we're seeing strength in the labor market, we're kind of seeing those inflation numbers stay high as well. We'll try to touch a quick question. We had a question come in a few minutes ago. It says, does the increase in the labor force and jobs created indicate new jobs, or does it reflect people needing second jobs to make ends meet? And it's a little bit of both, to be honest. Some of that work is part-time work. So, when they're showing jobs created, it's not always full-time work. There's definitely an element here that there is part-time work being generated. But that doesn't take away from the fact that, jobs are, there's a robust economy, there's growing jobs. And so that's always been part of these reports. And, I think the bigger thing is looking at some of these trends, seeing what's happening, seeing, GDP and spending. And we'll talk about that a little bit later in this section. But we're seeing that all continue to rise. So, I do think it's something to take into account and, maybe worrisome if people are, going out for second jobs and it's only part-time work. But that's always been part of this data. And, some of that part-time work has increased, jobs created. But I don't think the overall labor market in reports are kind of a mirage in terms of it's not as strong as maybe you would think. There is some element of that, but I do think we're seeing a pretty robust economy at this point. If we go to the next slide, just this element of higher for longer. And I won't talk much about this, but this gives you the historical, real inflate or real rate on the 10-year, really essentially the 10-year minus inflation. And you can see before the global financial crisis, it was hovering right around 2%. Ever since the global financial crisis, we were kind of in this artificially low yield environment or real rate environment, almost at zero, hovering just a little bit above zero for, you know, more than a decade, really. And as you can see, the 10-year now, as of today, it's 4.5%. That real yield is hovering a little bit over 2%, but it is a little bit more in line to pre-global financial crisis. And we may see at some point rates start to decline, but I do think that period between the global financial crisis of '07 to '09 and COVID, we may look back and really see that, hey, that may have been a little bit artificially low of an interest rate and yield environment. And, as of right now, we're kind of more in a normalized pre-global financial crisis. So again, just something to keep in perspective. We don't know exactly what will happen from there, but it's not outside the realm of possibility that we get into this more normalized, a little bit higher yield environment as we move forward. We talked last year, this is going back about 2 years, and this is a chart of the S&P 500 in red and the 10-year treasury rates. And for the most part, before 2024, as yields went up, you would see stocks come down, or vice versa. As yields came down, stocks would go up. A lot of the market was dictated by what interest rates were doing. I think whether it's good or bad, I do think you're seeing a little bit more of a correlation this year, meaning that, higher rates that we're seeing are not a detriment to stocks and to stock valuations. And so, we've talked about that a lot, saying that, hey, the market expectation were for rate cuts, that drove up the market, especially at the end of last year. We think going forward, even if we are in this, elevated interest rate environment, I think the most important thing is more about, fundamentals, earnings, outside of just what's happening with, the Fed or interest rates. I know today, kind of goes against that a little bit, but we're always going to see that short, today's, I think, CPI report was a little bit of a surprise. Market doesn't like surprises given, the sell-off today. But again, that feels like more of a short-term trend versus a, longer term trend that we're seeing so far in the first quarter of this year. Yeah, I think this is really interesting, and it's not so much important, all the percentages in each, graph here, but it's really the trend of GDP growth. And this is going back, since, middle of 2020, start of 2021. And you can see, GDP was growing really hot after, the beginning crash of COVID, right? But for some reason at the start of 2022, we had this 2 quarters of negative GDP growth. Typically, that's considered a recession. For some reason, at the time, we weren't calling it a recession for whatever reason. But when we talk about this, the most talked about recession that we were supposed to see last year, we've talked about this before. What if we already saw that recession? What if we already had that recession? And COVID did disrupt so much of what was going on in our economy, different sectors being shut down at different times. We sort of had this potential for a rolling recession. And when you look at this, graph over the last 3 years, we may have seen that sort of talked about recession for 22, may have already, or in what we were supposed to see in 2023, we may have already seen in 2022. So when we kind of look at our market outlook from here, we've seen a steady trend of strong GDP growth. The expectations for this first quarter is a little bit over 3%, right in line with what we've seen sort of on average looking back. And that does support this sort of mid-cycle bull market environment that I think we're in right now. But, that doesn't come without, some risks in the market. So let's talk about, some of the risks that are out there, some of the risks that we're talking about and trying to manage. Right off the bat, valuations are a little high right now. Valuations, have been creeping up over the last year and a half or so. Some of the earnings growth has supported this, but we're certainly seeing, valuations get a little frothy. We talked about that at our State of the Economy. And from a fundamental perspective, that is a little bit of a risk there. If we look at, how the top performing stocks make up their makeup of the S&P 500, this is going back, 45 years. The top 10 holdings in the S&P make up 32.5% of the market. That's pretty high. That's higher than we've ever seen over the last 45 years. Is that a good thing or is that a bad thing? Well, it could be viewed as a good thing. You have momentum. We've talked about, there was a report that went out, and I think I talked about it last year, that over the last 30 plus years or so, really the growth of the overall global financial markets have been driven by only 1.5% of the stocks that are out there. So you're going to get a lot of these great big companies that are driving market performance. That's kind of a natural evolution of the market. But we've never seen 10 holdings in the S&P make up such a high weighting. So I do think there is a risk there, but the dynamics of the market have changed, right? If you look back, 1990, tech stocks made up 5% of the market. Today, it's closer to 29%. It's not necessarily a bad thing because those are great companies. Those are growing companies. So you got to look at it from both sides, but it is something that, could be cause for some concern if we were ever to get a little pullback or some volatility, that maybe those top heavy stocks have grown a little too far. And you see in the next slide, this goes back over the last 35 years or so. You're seeing from a median, so kind of an average PE ratio. You look at those top 10 holdings in green. If you look at 2024, again, much, much higher versus the S&P than we've seen before. Again, though, market dynamics have changed. Having that much technology stocks and growth-oriented stocks towards the top of the market, they tend to trade at a higher PE multiple, price to earnings. So they tend, on average, trade a little bit higher. So seeing some of these higher numbers doesn't necessarily mean, a huge cause for concern. But again, it's something we want to take into account as we're building out our portfolios. The case for diversification. So again, we're saying that the market's going to be driven by earnings. And so this looks at, the 4 quarters of 2024, and it shows the Magnificent Seven in dark blue versus the rest of the S&P in light blue. And, we continue to see that growth in those Mag 7 companies. They continue to drive the market. The top 6 holdings, the 6 biggest companies in the world, in the S&P, in the S&P 500, are Mag 7 companies. The only one that's not even in the top 10 right now is Tesla, since it's been pulled back a little bit, but it continues to drive our markets. And so these earnings that we're seeing in the earnings growth from them, coincides with what we've seen in the market. But if you look at the rest of the year and what the forecasted earnings are, you actually see sort of a catching up from the other companies and from the rest of the market. And I think this can be a good thing, right? Finding, market finding its equilibrium, some, positive news for the rest of the market. And, even towards the end of the year, even though the Mag 7 earnings growth is coming down from what we're seeing at the start of the year, it's still double-digit growth. And so if we can hit those numbers and we can get there, again, this is what's supporting where the markets are today. This is a chart I saw. I wanted to share it. It shows in the dark blue the NASDAQ leading up to the tech bubble, 5 years leading up to the tech bubble versus the NASDAQ index the last 5 years of today, which is in orange. And yes, we're at high multiples. Yes, we're at all-time highs today. But when you look at, the trajectory of the NASDAQ 5 years leading into the 2000 tech bubble, it was a much, much different trajectory and upslope than we're seeing today. We're just sort of getting back to the all-time highs we saw 2 years ago towards the end of 2021. And so, with that, or 2022. So with that, I do think, or no, those highs were at the end of 2021. They bottomed out towards the end of 2022. So I do think it's important to just take that into context, right? If we're worried about, getting to all-time highs, if we're worried about, this bubble environment, we talked about it at the State of the Economy. We're not seeing that exuberance in the markets. We're seeing, more optimism than we've seen in a while, but we're not seeing that bubble-like exuberance. And I think this chart does a good job of showing that. And lastly, before we recap everything, all-time highs shouldn't worry us as investors. And so whether that, means you're fully invested right now, whether that means you're sitting on some cash on the sideline, it always feels tricky getting money to work, especially when we're at all-time highs. It never feels good to do that. But this graph shows over, 3-month, 6-month, 1 year, 2 year, and 3 year period. If you're investing at all-time highs, which is the green chart, versus just investing on any other day, so that's going to include some all-time highs, it's going to include, some down markets. Investing at all-time highs is actually a good thing. It means there's momentum in the market. We're seeing that with market breadth right now, seeing some of that good signs with earnings growth in other areas of the market. So just a good reminder that just because we're at all-time highs doesn't mean it needs to be a negative for the overall market. Doesn't mean we won't see some volatility on the horizon. We average, close to a 15% drop every year in the market on a historical basis, but investing at all-time highs shouldn't worry you from getting into the market or staying invested in the market. And just to close it out, some of the points we made, the higher for longer thesis still feels like it's in place. Both from Friday's jobs report to today's CPI report, seeing a lot of strength out there. And so, that's going to support probably higher rates. We are seeing, I think, the market's less dependent on rate cuts than we've seen over the last couple of years. And we do feel as though, markets will be driven by earnings. And so that's going to be critical as the year goes on. The economy continues to be strong. Again, our GDP is made up of, 2/3 of consumer spending. That should help drive future earnings growth. And I showed that graph of potential recession back in 2021. The most predicted recession that came to light for last year that we never saw. Maybe it already happened. Maybe that's already behind us. And then lastly, there's always going to be risks in the market. We talked about some of those valuations, top heaviness of the stocks, but it's hard to fully quantify that. The market dynamics have changed. There's much more growth in tech stocks that require higher multiples, but they're also showing a lot of earnings, a lot more earnings than we ever saw previously. So that's a good thing. Momentum can be a great thing in markets. Take advantage when we can, and we always are trying to balance that with an appropriate risk management and diversification. So with that, we thank everyone for joining us today. Thank you to Paulo for joining us as well in presenting. As always, this will be available on our website, within the next couple days. We'll share both the presentation in terms of, this presentation, but also the slides that we used will be available. So you can take a look. And if you have any questions or want to talk about anything that we went over today, please don't hesitate to give us a call. We'd be happy to discuss this with you. So with that, have a great rest of your day. Thank you again for joining us, and we'll talk to you soon.